Welcome back to the deep dive. We are looking at a market today that feels, well, have you ever watched a movie where the audio is just slightly out of sync with the video?
Oh, yeah. It makes you want to just turn the TV off immediately.
Right, it's incredibly disorienting. And honestly, that is exactly what the financial markets feel like right now.
Yeah.
It is a total split-screen reality.
Yeah. You look at one side, the stock valuations, and they are flashing bright red. We're talking historically expensive, just nosebleed levels.
But then you look at the other side of the screen. The credit markets, the plumbing in the financial system. And it is completely calm, serene even, green lights everywhere.
Which doesn't make any sense.
Exactly. So that is our mission today. We are going to figure out which screen is actually telling the truth. We need to unpack why the famous Buffett indicator is screaming danger while corporate bonds are basically hitting the snooze button.
Right. And more importantly, we're going to shine a light on a massive, a $1.8 trillion dark corner of the market called private credit.
And I am so glad we are focusing there today, because this isn't just, dry finance stuff. This is a story that ties together the AI boom, your life insurance policy, and a type of financial engineering that feels, well, it feels uncomfortably similar to the housing bubble back in 2008.
It really does.
Yeah.
We are pulling this intel from two main places today. First, we have a snapshot of the Druckenmiller dashboard, which gives us a look at the macro risks right now. And second, we've got a really detailed breakdown from portfolio manager Steve Eisman.
Wait, the guy from The Big Short?
The very same.
Wow, okay. If the guy who bet against the subprime mortgage crisis is worried about credit, I'm definitely paying attention. Now, before we get into the red flags and the green lights, we do have some resources for you to follow along with the data we are discussing today. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai.
All right.
And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
And just a quick disclaimer for everyone listening, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations.
Exactly. All contents from this channel is for educational and research purposes only and does not constitute investment advice.
So conduct your own due diligence before making investment decisions. And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values.
Don't forget to like this video. Much appreciated. Okay, let's unpack this dashboard. I want to take the temperature of the room here. If we look at the valuation category from the Druckenmiller dashboard, what are we actually seeing?
We are seeing a market that is fundamentally priced for perfection. It is bright red. There are two numbers you really need to wrap your head around here. First is the Buffett indicator.
Right.
That is the total market capitalization of all U.S. stocks divided by the country's GDP.
So basically, it's the price tag of the entire stock market versus the actual economic output of the country.
Precisely. And historically, if that number went over 100%, value investors would start getting really nervous. Today, we are sitting between 220 and 230%.
That is just massive. That implies the price of stocks has completely detached from the reality of the underlying economy.
It's a structural overvaluation. It means for every single dollar of economic output, the market is asking for $2.30 in stock value. And the second metric confirms it too, the Schiller KP ratio.
Which adjusts price to earnings for inflation over 10 years, right, to smooth out the noise.
Exactly. That ratio is currently sitting over 40.
Just for some context, what is normal for that?
The long-run average is about 17.
Wow.
So we are more than double the historical norm. If you were buying a house, this would be like paying double the appraisal value just because everyone says the neighborhood is hot.
Now, if I saw those numbers in a vacuum, I would assume investors were absolutely panicking. I'd assume everyone was rushing for the exits because the prices are just way too high.
And that is the paradox. That's the split screen. While valuations are screaming danger, the macro signals are mostly green, specifically credit spreads.
Break that down for the listener who maybe doesn't trade bonds every single day.
Sure. A spread is just the extra interest a company has to pay to borrow money compared to what the government pays. So when investors are scared that companies might go bankrupt, they demand a high interest rate. That's a wide spread.
Makes sense.
But right now, high-yield spreads, what we used to call junk bonds, are at roughly 2.9%. That is incredibly tight.
So the bond market is essentially saying, we think there is almost zero risk of these companies defaulting anytime soon.
It's incredibly calm. If you check the Chicago Fed Financial Conditions Index, it's negative.
Negative meaning, wait, does that mean bad?
Actually, in their language, negative means loose. It means there is plenty of money just sloshing around the system. Even the VIX, the fear gauge, is just drifting in the yellow zone.
So we have a red valuation alert and green liquidity lights. How does the dashboard actually score that mess?
It gives it a total risk score of 7 out of 20. It literally calls the environment neutral with a cautious risk-on tilt.
Calling it neutral feels really generous when stocks are double their historical average.
It is the liquidity argument. As long as money is cheap and abundant, the party can just keep going. But here is the catch, and it's a big one. Because valuations are so stretched right now, there is no shock absorber. If anything goes wrong, a geopolitical spike, a policy error, the drop could be vertical. We are driving 100 miles an hour on a perfectly smooth road, but we don't have any airbags.
Well, speaking of things going wrong, we just saw a live example of a shock with the tariff turmoil recently.
Oh, yeah. That was a curveball for sure.
So the Supreme Court struck down the administration's use of the IEPA to impose tariffs. And for a minute there, that looked like it was going to blow up the president's entire trade policy.
It was a huge check on executive power. The market definitely held its breath for a second, but notice the pivot there. The administration didn't fold.
Right.
They pivoted immediately to Section 122 of the Trade Act of 1974 to slap on a temporary 15% tariff, and then opened new Section 301 investigations.
It's like a game of legal whack-a-mole. You hit one statute, another one just pops right up.
It is very messy legally. But from a market perspective, Treasury Secretary Scott Bessent is arguing that despite all the legal gymnastics, the actual revenue collected won't change much.
He called it fiscally neutral, right?
Exactly. So the government gets its money, and the market just moves on.
But markets usually hate uncertainty. And this brings us to something that really surprised me during that whole news cycle, the reaction from Bitcoin.
Oh, this was a fascinating litmus test.
Because the sales pitch for Bitcoin has always been, it's digital gold. It is a hedge against government chaos. If the dollar gets shaky or the government hits a legal wall, you are supposed to buy Bitcoin.
That is the theory anyway. If the government is flailing and trade policy is completely up in the air, Bitcoin should be your safe haven.
But it didn't work that way.
No, it didn't. On the day of peak tariff uncertainty, Bitcoin fell. It tanked. And Steve Eisman jumped all over this in his notes. He said it proves that Bitcoin isn't behaving like a hedge or a currency at all. It is behaving exactly like a high beta tech stock.
High beta meaning it just magnifies whatever the NASDAQ is doing.
Pretty much. If tech stocks catch a cold, Bitcoin gets the flu. Eisman had a really biting line about it, actually. He said Bitcoin might just be a vehicle for speculating about speculating.
Speculate about speculating. Wow.
Yeah, because if it drops when systemic risk rises, it fails the basic test of a safe haven. It's not gold, it's just another risk asset.
That is a harsh reality check for the crypto bulls.
Yeah.
But I want to pivot to the main event here. The thing that Eisman thinks is the actual structural risk right now.
Yeah.
Not Bitcoin, not tariffs, but private credit.
This is the $1.8 trillion elephant in the room.
For those who aren't familiar, private credit is essentially non-bank lending. It is private equity firms lending money directly to companies, completely bypassing the traditional banking system.
And it has exploded in size because banks pulled way back after 2008 due to regulations. So private equity just stepped in to fill the void. But now we're starting to see cracks form. Eisman points to a firm called Blue Owl as the canary in the coal mine here.
Blue Owl is a massive player in this space. And recently, they had to freeze redemptions on their funds. Investors wanted their money out, and Blue Owl basically said, sorry, we can't pay you right now.
Which is bad enough on its own. Illiquidity is a killer. But to get cash to actually pay those investors, Blue Owl had to sell off a chunk of its loans, about $1.4 billion worth. Now, normally, when a fund sells loans, they sell them to a big bank like JP Morgan or maybe a pension fund.
And they did sell some to pension funds. But there was a fourth buyer in this mix. And this is where the story gets, as Eisman puts it, funky.
Funky is a good word for it. The fourth buyer was Kuvari Insurance.
And who owns Kuvari Insurance?
Blue Owl owns Kuvari Asset Management. They bought them in April 2024.
Okay, let me make sure I have this straight for everyone listening. Blue Owl's credit fund is in trouble. They need to offload loans to get cash. So they sell those distressed loans to an insurance company that they themselves control.
Precisely. It is an Ouroboros risk. You know, the ancient symbol of the snake eating its own tail. You have an entity controlled by Blue Owl using insurance policyholder money meant for grandma's annuity or life insurance payouts, to buy loans from Blue Owl's own distressed funds.
That sounds like a massive conflict of interest. It sounds like they were just moving the toxic waste from one pocket to another pocket.
It is actually worse than just moving it. It is about regulatory arbitrage. This is a bit technical, but it's crucial. A private credit fund might be levered 2 to 1. Meaning for every dollar of equity, they borrow $2.
Okay, fair enough.
But insurance companies play by completely different rules. They can take those exact same loans, wrap them into a CLO, a collateralized loan obligation, and lever them up 10 to 1.
10 to 1. So they are taking risky loans, moving them to an insurance company, and then multiplying the leverage by 5 times.
Yes. You are transferring risk from private equity investors who theoretically know the risks and signed up for them over to life insurance policyholders. And you are magnifying that risk in the process. Eisman is flagging this as a major systemic issue. It is hiding risk in the one place that is supposed to be safe.
But we really have to ask the fundamental question here. Why are these loans distressed in the first place? What actually happened to the companies they lent the money to?
This is the plot twist. The culprit is artificial intelligence.
Wait, I thought AI was booming. How is AI causing defaults?
It is the software problem. See, for the last decade, private equity loved buying software companies. B2B saw software as a service. They thought it was the absolute perfect business model. Recurring revenue, high margins, and a big moat around the business. Once a company installs software, they never leave, right?
Yeah, that was the conventional wisdom for years.
It was. And estimates say 20% of the entire private credit market is made up of loans to software buyouts. But then ChatGPT arrived. Large language models hit the market. And suddenly, writing code became cheap.
So that moat just evaporated overnight.
Exactly. UBS actually put out a report predicting private credit default rates could surge to 15%. Why? Because AI destroys the pricing power of legacy software. If a startup can build a competing software solution in a weekend using AI agents, the legacy company that charged millions for it is dead. Their margins get absolutely crushed.
So these private equity firms are sitting on billions of dollars of loans to software companies that are becoming obsolete in real time.
Eisman says they are victims of their own enthusiasm. They funded these deals 3 or 4 years ago, assuming the old rules still applied. They just didn't see the paradigm shift coming. It's like they bought Blockbuster right before Netflix started streaming.
That is a terrifying chain reaction. AI disrupts software, then software companies default. Private equity moves the bad loans to insurance companies, and then the insurance company is levered 10 to 1.
That is the big fear right now. And because private credit is opaque, there is no daily stock ticker for these loans, we don't really know how bad the rot is until it breaks.
Well, speaking of stock tickers, we can see who is winning and losing the AI war in the public markets. The recent earnings season has been brutal for anyone on the wrong side of this trade.
We have to start with the king of AI infrastructure. NVIDIA. The numbers are just staggering. Revenue was $68.1 billion in Q4. That is up 73% year over year.
For a company that size, growing at 70% is absurd. That is startup growth at a trillion-dollar scale.
It is. Earnings per share was up 82%. They're literally printing money, and yet the stock opened down the next morning.
Why? Are investors just spoiled at this point?
It is CapEx anxiety. The narrative is that big tech companies, your Googles, Metas, Microsofts, are spending hundreds of billions on NVIDIA chips, but they aren't making enough actual profit from AI yet to justify it. Investors are terrified the spending spree will eventually stop. It's the fear of an air pocket in demand.
Even though NVIDIA is trading at a PE of around 25, that seems incredibly cheap for that kind of growth.
It is cheap, but that low multiple tells you the market doesn't believe the growth will last. It is pricing in a clank. It is saying, this is as good as it gets.
Now, contrast that with the roadkill of the AI narrative.
Yeah.
Salesforce.
Yeah, Salesforce is hurting, down significantly this year. They beat their earnings expectations, but the guidance was light, and the market punished them immediately.
Is that AI overhang again?
Exactly. Investors look at a seat-based software license model like Salesforce and ask, will AI agents replace the human who uses this software? If companies hire fewer people because of AI, they buy fewer Salesforce licenses. That fear is crushing their multiple.
It is fascinating how binary this is. You are either the AI infrastructure NVIDIA or you are the legacy victim. But let's step away from tech for a second. What about the real economy? Look at Home Depot and Lowe's.
This gives us a look at the consumer, and the picture is just frozen. Home Depot's same-store sales were basically flat, just up 0.4%.
Why aren't people fixing up their houses?
It is the golden handcuffs of the housing market. Existing homeowners locked in 30-year mortgages at sub 4% a few years ago. Rates are near 6% now. Nobody wants to sell and swap a cheap mortgage for an expensive one.
So housing turnover has just collapsed.
Which means no big renovations. If you aren't moving, you aren't redoing the kitchen to sell the place, the housing market is just stuck in amber. It is a lock-in effect that hurts every business dependent on housing turnover.
One more sector I want to touch on quickly, solar. First, solar took a massive nosedive, down 15%. What happened there?
A complete disaster. They missed earnings by a mile. But the bigger story is political. The commercial solar thesis relied heavily on federal incentives and assumed demand from data centers.
And the new administration isn't exactly rolling out the red carpet for renewables.
Right. The removal of incentives and the general political headwinds are crushing the outlook. It is a harsh reminder that policy shifts like tariffs or subsidies pick winners and losers instantly. You can have a great technology, but if the federal subsidy goes away, the stock crashes.
Okay, we have covered a lot of ground today. We have a red alert valuation dashboard, a hidden private credit crisis involving insurance schemes, AI eating software, and a frozen housing market.
It is a lot to process. It is a really heavy mix.
It really is. And it makes me ask the question, in a market this complex, with Ouroboros risks and regulatory arbitrage, does a regular retail investor even stand a chance?
It is a totally fair question. Eisman was actually asked this too, and he admitted, look, the pros have unfair advantages. They have Bloomberg terminals, they have expert networks where they can call up industry insiders. They get the information first.
Which sounds depressing, honestly. It sounds like the game is rigged against you.
But, and this is the key takeaway, Eisman also pointed out that despite all those advantages, the indices just buying passive index funds almost always outperform the active managers over time.
So all that data, all those expensive Bloomberg terminals, and they still can't beat a simple index.
Often, no, because the market is efficient, and their high fees eat up whatever edge they have. Plus, pros tend to overthink it. They try to time the market. So for you, the listener, you don't need to outsmart Blue Owl or predict the next move of the Fed. You just need discipline.
That is surprisingly reassuring.
Mm-hmm.
So, how do we synthesize this deep dive? What is the one thing listeners should walk away with today?
I think we have to go back to that split screen image. We have a market that is priced for perfection. That is the red valuation. And it is being held up by calm credit markets, the green lights. But underneath the floorboards, there is rot in the private credit sector.
The software loans going bad.
Yes. You have private equity firms frantically trying to plug holes by selling bad loans to insurance companies they control, all while the AI revolution undermines the value of the assets those loans are built on in the first place.
It feels like the music is still playing, but the chairs are disappearing one by one.
And that leads to the provocative question I want to leave everyone with. We always look for the next crisis in the banks. We look at Wall Street. But what if the next financial crisis isn't in a bank at all?
What if it is hiding in your annuity?
Exactly. If those insurance companies are holding the bag for failed software buyouts, levered 10 to 1, that is a risk that hits Main Street directly. It isn't just a number on a screen. It is people's retirement security. It is definitely something to think about the next time you look at that safe life insurance policy.
Definitely something to mull over. Thanks for joining us on this deep dive. We'll see you next time.
Stay curious.